Most people think they understand gold. They think it's simple. Rates up, gold down, rates down, gold up, fear up, gold up, dollar up, gold down. It sounds clean. It sounds logical. It sounds like the kind of rule you can tattoo on your forehead and never think again. And then the market does the thing it always does. It makes the simple rule people look foolish. Because there are real stretches of time, especially in stressed regimes where rates are rising, yields aren't cooperating, and gold still climbs anyway. And when that happens, people either call it manipulation or they call it a fluke. It's neither. It's structure. And if you understand the structure, you stop getting confused and you stop getting emotionally whipsawed by headlines that act like gold is supposed to behave a certain way. So today we're going to answer one question in plain English. How can gold rise even when yields are up? Not in theory. Not with textbook slogans. Mechanically, what has to be true for that to happen? And then I'm going to give you a simple watch list so you can tell whether you're seeing a real shift or just a short-term tug-of-war. Quick check-in before we start. Comment one word, rates or fear. Which one do you think is driving markets more right now? One word, then we move. Okay, let's start with the misconception. People say yields up means gold should fall because they assume gold is competing with bonds on a single dimension, yield. Gold doesn't pay interest. So if bond yields rise, bonds look more attractive. That's the clean story. The problem is markets don't trade yields, they trade conditions. And the condition that matters most for gold is not yields, it's trust and liquidity. It's whether the system feels stable enough that people want to own promises, or whether they want to own something that isn't someone else's liability. Gold is not just an asset, it's a confidence meter. So yes, higher yields can be a headwind, but in the real world, gold is pulled by multiple forces at the same time, and sometimes the force pulling it up is stronger than the force pushing it down. That's why you get those moments where rates are up, fear is up, and gold says, I don't care, I'm going higher. Now here's the clean framework that makes this make sense. Gold rises for two broad reasons. Either the opportunity cost of holding it is falling, or the demand for safety is rising faster than opportunity cost can suppress it. And in stressed regimes, safety demand can get weirdly powerful. Now when people say yields don't cooperate, they usually mean one of two things. Either yields are rising in a way that should hurt gold, or real yields after inflation expectations aren't behaving the way the simplistic story assumes. That second point is where most people get lost. So I'll keep it simple. Gold doesn't care about nominal yields in isolation. It cares about what those yields mean for purchasing power and stability. If yields rise because inflation expectations rise too, the real return may not improve the way people think. And if the market starts questioning purchasing power or stability, gold can catch a bid even with higher nominal yields. But I promised no lecture, so let's translate this into plain English mechanisms. Here are 4 ways gold can rise even when yields are up. Mechanism 1. The rise in yields is a stress signal, not a confidence signal. This is the one people miss. Sometimes yields rise because the economy is strong and growth is booming. In that world, higher yields are healthy. Risk appetite is high. Gold can struggle. But sometimes yields rise because investors are demanding more compensation for holding debt, because uncertainty is rising, because supply is heavy, because credibility is questioned, because volatility is increasing. In that world, higher yields aren't good. They're a warning label. And when yields rise as a warning label, gold can rise too because fear is rising at the same time. So the question is not, are yields up? The question is, why are yields up? Mechanism 2. Currency effects and global demand can overpower the yield headwind. Gold is a global market. If investors in multiple countries are chasing safety or hedging currency risk, gold can rise even if yields in one country are rising. If the local currency is weakening, gold priced in that currency can rise hard, even when yields are up. So you can get an environment where yields rise domestically, but currency stress and global demand push gold higher. Mechanism 3. Risk-off liquidation elsewhere forces a rotation into safety. This sounds paradoxical because forced selling can hit everything at first. And yes, in the first wave of a liquidity event, gold can dip. But after the first wave, when the market moves from sell what you can to own what you trust, gold can outperform even while yields remain elevated. Think of it like phases. Phase 1, cash raising, everything liquid can be sold. Phase 2, safety selection. People choose what to hold when they're scared. Gold often benefits more in Phase 2. So if you're watching gold rise while yields remain high, you might be watching the market move from liquidation to allocation. Mechanism 4. Positioning and flows can dominate the textbook story. This is the one no one wants to admit, because it's not cinematic. Markets are not moved only by beliefs. They're moved by positioning. If a huge number of people are positioned for gold must fall when yields rise, and then gold doesn't fall, they start getting uncomfortable. They cover, they reduce, they buy back risk. That creates demand. If you combine that with rising fear, you can get an upside move in gold that looks illogical to people who only know slogans. It's not illogical, it's flow. Now I want to make this even clearer with one simple concept. Gold is not a one-factor trade. It's a tug-of-war. One side is opportunity cost, yields, dollar strength, carry. The other side is trust and fear, stability, hedging demand, systemic anxiety, and whichever side is stronger in that moment wins. So when you see rates up, fear up, and gold rising, you're seeing fear overpowering opportunity cost. Now here's the part that matters for your decisions. How do you know when fear is strong enough to overpower yields? You watch behavior, measurable behavior. Here's the watch list. First, are yields rising with rising volatility? If yields are up but rate volatility is spiking, that often signals stress rather than confidence. Stress tends to support gold. Second, are risk assets behaving like they're in trouble? If stocks are shaky, credit spreads are widening, and correlations are rising, fear demand can grow fast. In those environments, gold can rise even with high yields. Third, what is the currency doing? If the currency is under pressure or swinging violently, gold can catch a bid as a hedge even if yields are up. Fourth, what are inflation expectations doing relative to yields? You don't need to be a model. You just need to notice whether higher yields actually represent improved real return, or whether inflation expectations are moving too. If real returns aren't improving much, gold's headwind is weaker than it looks. Fifth, are rallies in gold holding? In a fluke move, gold pops and then fades quickly. In a regime move, dips get bought and the market holds higher levels. Follow through matters. Now I'm going to give you the clean scenario tree, because after you understand the why, you need to know what to expect next. There are 3 lanes when yields are high and fear is rising. Lane 1, gold grinds higher while yields stay elevated. This happens when fear demand stays steady and the market wants insurance. Lane 2, gold chops violently. Opportunity cost and fear keep trading punches. You get spikes up, pullbacks, and lots of false confidence on both sides. Lane 3, gold fails. If fear cools down and yields remain high, opportunity cost can reassert itself and gold can stall or drop. 3 lanes. And again, you don't predict the lane with certainty. You watch the signals and manage your risk so you're not crashable. Because the biggest mistake people make here is they turn the relationship into a religion. They think gold must do X because yields did Y. The market doesn't owe you clean relationships, especially not in stressed regimes. Now I'm going to talk directly to the people who keep getting wrecked by this tug of war. If you're trading gold with leverage, understand what you're actually trading. You're trading a multi-factor tug of war in an environment where volatility can change the rules. That means position size matters more than being right, because the market doesn't have to beat your thesis. It only has to beat your margin. If your position can't survive a sharp move against you, you're not trading a thesis, you're gambling on timing. And timing gets punished the most when relationships break down. If you're not using leverage and you're holding gold as insurance, your job is different. Your job is not to win daily. Your job is to not panic when gold doesn't behave like a meme. Insurance doesn't pay you every day. It pays you when the environment asks for it. Now, one comment prompt, and I'm keeping it to one. Which do you think wins over the next month? Fear or yields? One word. Fear or yields. And here's the final takeaway. In one sentence. Gold can rise with higher yields when those yields are signaling stress or when fear demand for insurance overwhelms the opportunity cost headwind. If this helped you, subscribe. I'm going to keep explaining these contradictions in plain English, because most people lose money not from ignorance but from believing the world has to behave like a simple rule. And send this to one person who keeps saying gold can't rise if yields are up. Not to dunk on them, just so they stop getting surprised by a market that doesn't care about slogans. Educational only. Not financial advice. I don't know your situation. Nothing here is a recommendation to buy or sell anything. Manage your risk, make your own decisions, and don't let a single relationship control your entire worldview.